Hey everyone, how's it going? My name's Austin Hankwitz, and welcome back to the sort of fun but also super educational little series I've been doing with Katie Stockton, a absolute mastermind with technical analysis, as we continue to navigate this ever-evolving market that we've been experiencing since COVID started. If you guys aren't aware or maybe recognize Katie, which I'd be surprised if you haven't if you watch CNBC, she is a absolute, like I said, mastermind with technical analysis, tons of certifications. I'll let her introduce herself and talk to her all that fun stuff. But you've likely seen her on CNBC and all these other cool places for interviewing financial professionals. So Katie, take it away.
Great. Thanks, Austin. I appreciate that. So I am a CMT, or a Chartered Market Technician, and essentially that means technical analysis or charting, supply and demand, price-based analysis. That's really my expertise. It's what I do every day, all day. And we publish research for individuals, for institutions, and we also provide consulting services at Fairlead Strategies, which is a firm I started in early 2018 after having been on Wall Street for the better part of 20 plus years.
Wow.
So here we are right now adapting to these new forums and technologies. And yet we're adapting also to the market, right? And we always are. We always have to. It's a very dynamic beast. And I think that the charts are really one of the best ways to try to navigate the markets. And, I call it the inverse property of technical analysis. When the markets go down, the demand for technical analysis goes up. So,
absolutely.
People were wondering what to do with their positions, with their portfolio. And the charts can provide, with sort of an unbiased perspective, some color on whether it's a minor reversal, a major reversal. Do we have a selling opportunity at hand? An idea of different levels that might have importance and of potential duration. It's not designed to really be ultra predictive, but to understand if there is some kind of big important shift underway. So that's part of our goal.
I love that. So let's quickly, though, kind of go back. You mentioned Fairlead Strategies. Where can people find Fairlead Strategies? I know you're recently added to Substack. Where else can they find some more of this awesome information that you're sharing?
Thanks. Yeah, no. So we have a website. It's fairleadstrategies.com. And through that website, folks can request a trial. We offer 1 month free trials to our services, whether it's simply the research product or also the consulting. We have an equity-focused product that is actually including a daily report and 2 different weekly reports. And we cover in that macro technical forces, things like gold and treasury yields, anything that impacts equities, especially sector work and sector relative strength. We do approach markets top down, but we also do a lot of idea generation from a bottom-up stock perspective. And part of that is now delivered via Substack, as you mentioned, and you're our inspiration for having started our Substack newsletter. We saw how successful you were with yours and your content delivery, and really wanted to in part sort of leverage what you were doing on the fundamental side, which we find to be incredibly robust and in-depth, and also very clear and easy to understand for someone like myself who's not at all fundamentally oriented. So we've had some good luck, with that Substack newsletter, posting long ideas up to 3 to 4 per week, and just trying to navigate a very difficult tape in which to find these long ideas. And that can also be accessed via our website. We do have a Twitter feed as well. It's not the most active feed, but that's at Stockton Katie.
Got it. Perfect. No, I appreciate that. So you mentioned, navigating all this stuff, right? We've been navigating a insane stock market since COVID, right? And now it seems like we're beginning to navigate the downside of that. If that's a correction, some might call it a healthy correction, as I'm trying to think about it as, or if it's just a straight up bear market, right? So you are an absolute mastermind magician with technical analysis. You understand it like the back of your hand, and I am trying to learn as much as I can about it. And I'll certainly be asking probably some silly questions in this video. Talk me through now how folks can leverage technical analysis, if it's indicators, if it's just data, if it's whatever that might be, right? Talk me through how folks can leverage technical analysis to navigate a bear market, to make sure that they're kind of like not catching a falling knife, right? To make sure we've kind of maybe found that bottom, or I don't know, right? Like just walk me through some of that.
Yeah, I mean, I think the first thing is more big picture, not as it pertains to the current market environment, but as it pertains to technical analysis in general. I think the best way to leverage it is to approach it somewhat systematically. And by that, I mean you have to have sort of a suite of indicators or tools that you're using, and you're coming back to them repeatedly, because that's where you're going to, one, just get to know those indicators and those tools that you're using very well and their nuances, and that's always helpful. But also that's where you take out the subjectivity that we're all unfortunately very subject to. I think, if you have an indicator that's flashing a buy or a sell signal, you really can't argue with that. It's mathematically driven based on price. But if you're choosing to look at whatever you see fit at that moment from a technical perspective, well, you're probably going to have that confirmation bias where you're looking for something that makes sense to you for other reasons. So rather than collecting a lot of sort of technical information that's out there floating around, to do it yourself in a systematic fashion where you have the same tools and indicators or people that you're going back to regularly whose process that resonates with you. So I think that's the best way to approach it in general. And then as it pertains to bear market environments, I mean, that's at the end of the day what we're all trying to avoid, right? And, we moved to a neutral longer term bias in October of last year. I think we talked about that last video. And that was largely based on some overbought sell signals is what we call them on the long-term charts. So certainly an eye towards these overbought, oversold measures would be important as part of a process, in my opinion, because those will be sell signals that are generated into up moves, and they're not always super timely. In fact, the market is generally trending higher, so you'll get a lot of false overbought sell signals. But to have knowledge that those sell signals are there can be really helpful in that you can understand where something might be getting stretched. And if with that in mind, you'd be more respectful of a loss of momentum, which is, of course, what we saw in January. So in January, the loss of momentum, it's really more intermediate term in nature at this time. But we have seen some meaningful deterioration also on the long-term charts, not as much for the S&P 500 index yet, but for the NASDAQ 100 index and also the Russell 2000 index, which is a small cap benchmark, we have some very real downturns in our long-term or monthly indicators. And I really depend on these indicators personally to help me understand when we might be at a point where we can feel more comfortable adding exposure. So it's a matter of combining timeframes. We're looking at both the monthlies and the weeklies as part of our process to try to understand when we have anything more than just a very short-term relief rally underway. Arguably, that's what we have underway at this time. So we've not told people to buy into this bounce, but rather to think of it as something that might present a selling opportunity. And, even before that, we were talking about managing risk. So hedging exposure, you can use inverse ETFs as an example. To minimize your exposure, simply reduce the exposure by selling some stocks in your portfolio, and also managing risk through tight stop losses. So in our Substack posts, which are a little lower conviction than we want them to be, we're just saying, hey, listen, this is either a short-term position or we're trying to get some defensive exposure. But because of the risk from the broader market, we want to establish a very, very tight stop loss. And that's a great way to manage risk, albeit very simple. And the charts lend themselves really well to providing support levels below which you want to put these stops. So you don't want to see a stock break down. And that's essentially what's happening when you take out a support level where you've seen buyers step in the past. And that support level can be a moving average. It can be a previous trough in the chart. It could be, a different technical model. But again, going back to those same tools, I think is important, or having an understanding of support and resistance will also be important as part of that process. So it's a matter of having those indicators on our side. And then when we get the buy signal, which of course is quite the opposite of what we're seeing right now, that's when we feel comfortable reasserting long-term exposure. So as it stands, we don't have long-term buy signals, nor do we have intermediate-term buy signals on a widespread basis, but we do have widespread short-term oversold buy signals that unfolded at the start of this week.
Okay, widespread short-term buy signals. Okay, got it. Okay, so all these words, I'm trying to keep up. So what's funny to me though is whenever I've heard about navigating a bear market, or to think about buying the dip, what that could mean, right? Is how I've been taught, how I've read online really, is, you start to think about it once the market or the price of what the asset is, right, has declined, especially the market. I don't think this at all applies to cryptocurrencies because they go up and down way more than the market does. But once it's declined about 15 or 20%, that's when you start saying, okay, maybe things will begin to slow down. This is from recent all-time highs, right? So when things begin to slow down, let's begin to sort of reassess and see what's going on and really kind of feel out, what's, the underlying drivers, if it's the economy is also doing bad, if the economy is doing fine, or what's really, driving this volatility. But to your point, to also, yes, keep that in mind while looking around to other things, if it's perhaps volume or different types of, you mentioned back in, October, you guys had this sort of neutral rating, which seemed to come true, right? It's just interesting, right? How there's different types of ways that people could approach this, both from a very hands-on perspective of continually looking at the daily, the weekly, the monthly types of charts and different types of data points that come with that, along with more maybe a even passive perspective, which is sort of how I think about it, where it's like, we're down 15, 20%. Things are still looking fine. I still have my deepest convictions in different companies, right? We just saw Google crush it. Apple crushed it. Microsoft crushed it, right? All these companies are still doing well despite the overall stock market trading down. So is this now something that I ask myself? It's like, are we, is the stock market trading down because of the fundamentals, or is it trading down because of the Fed and these, the rate hikes and all these things that people are afraid of, right? So that's been my experience personally, and I look forward to leveraging more of what you're making to help me navigate this bear market as well. So moving forward now, can we look at some charts of perhaps the indices? Maybe we can look at the S&P 500. I think perhaps even maybe the NASDAQ could be a good idea. You mentioned the Russell. I don't know if mid-cap stocks would be a good thing to look at, but certainly the S&P and perhaps the NASDAQ could be beneficial to check out those indices.
Yeah,
I'm not seeing some good stuff.
here's Command Central here. So to your point, Austin, I think you bring up actually a very good one, almost maybe without knowing it, in that you're talking about fundamentals and being the drivers of these long-term trends. And indeed, I wholly believe that that's the case. But where the charts are especially important is in understanding when these top-down moves occur. And, what happens when you do see a corrective phase, correlations tend to go way up on the individual stock level. So it makes the stock picking less successful, less important. It doesn't mean these are companies that have had any changes in their fundamental, prospects, right? But what happens is that they just simply get dragged down by the broader market. And so it's a matter of differentiating between the top-down influences, including something like the Fed and technicals, and then also having that kind of bottom-up support to what you're doing. But, a lot of very conservative investment strategies would agree that, you see 10, 15% downside, and over history, of course, that's been a pretty fair entry point for positions that are trending higher. So just looking at the numbers in that way, you can certainly make the case for doing that kind of thing. But I would prefer, as a technical analyst, to have the momentum on my side before doing that, because there is always that risk that there's a 2000 or a 2008, unfolding. In order to sort of minimize that risk, and also, maybe minimize the risk of another 10% downdraft this time around, to have the momentum shift before you get back into those positions is really key here. So what we have on the screen is a monthly chart of the S&P 500, and you can see that the nice up move here. You can ignore some of the indicators that are on the chart here, but fact of the matter is this prolonged overbought reading that you see in this, this is called the stochastic oscillator. Prolonged overbought reading has been in place for really close to 2 years. It's when you see it downturn below this 80% level, which is an overbought threshold, that's when you have a sell signal. And so as it stands, we don't have a sell signal that's decisive for the S&P 500. But as mentioned back here, we had some indications from something called the DeMark indicators that we might see it tire out a bit. And notice on this momentum gauge, this is a really good thing to have on your side over various time horizons. It's the MACD indicator, very common trend following or momentum gauge. And it's been on a buy signal, which happened back here since mid-20. And notice it's getting a little bit pinched towards the sell signal. Now, when you get a sell signal, that's what we take issue with. Now, here's the catch, right? Beyond the S&P 500, we have those sell signals. So the NASDAQ 100 index on the same long-term view, you can see has the stochastic downturn. It has the MACD sell signal just based on this falling below 80, this flashing a sell signal. And these are the things that we can't argue with. It's mathematically derived. We also have issues per those same DeMark indicators. So the sort of reminiscent of, I'd say, early 2018 is what we've been imparting to our clients to say that it doesn't mean we're getting into that 2008 type of bear market, but certainly you could see a digestion phase like we had in 2018 where the market was more sideways off of similar signals and setups. And I think it's a matter of allowing the market's price history to give you some guidance. It's not to say that it's going to repeat itself exactly, but it certainly can rhyme with past environments. So we're making the call that there's going to be a lot of volatility this year, both to the upside and to the downside. But the end result perhaps is more neutral as the strong gains over the last couple of years are digested in sideways price action. So that's the NASDAQ 100 index. Let me show you on the support levels that we're watching here, because that's always of interest typically. Here's a weekly bar chart of the NASDAQ 100. Here was the sell signal. It's still working that sell signal off. It came into this gray line here, which is about 14,400. And that would be a natural place for support to be discovered. It's a Fibonacci retracement level, and you can see it also aligns with a previous low on the chart and the shaded area, which is called the cloud model. So natural place for this bounce to be unfolding. With a retest of support, we would expect a breakdown, and we say that because intermediate term momentum is weak, and obviously long-term momentum has weakened. And then we try to use next support as a gauge of downside risk. Currently, next support is roughly 13,000, and naturally we want to avoid a corrective phase of that magnitude. And then it means we have to think about, where we might find outperformance and underperformance if we do see that second down leg, and make sure to manage through that from sort of a risk management perspective.
Wow. Okay. Got it. This is interesting. So I was doing a little bit of digging on the dark arts of Twitter, right? The deep web. And I saw a couple of folks that were also thinking about, technical analysis with the NASDAQ and things of that nature. And they were saying that around this 12,000 point range is where they're thinking that we could begin to see some of this trading sideways that you alluded to from 2018. I'm not asking you at all to try and predict the stock market, because I don't think anyone can do that. But do you think that, you mentioned, in 2018, it was more of like this sort of trading sideways, kind of crabbing back and forth. And I would argue that, if we look back at the underlying economy and all these other different things, like, sure, inflation's running hot, but there are a lot of things to look forward to, right? Housing's doing great. Jobs are doing, like, all these things are doing well. Goldman Sachs just put out a note saying that there's a lot of bullish undertones for the next 12 to 18 months for the economy. Do you think that, as we see this healthy correction that's certainly taking place now and will likely continue over the next couple months, do you think that will, the economy that is, kind of be like a buoy to kind of keep things moving forward versus like just 2008? I mean, everyone was unemployed, right? People were screaming and yelling and everyone was freaking out. I don't think we're like that right now. So just to like hypothesize here, I don't think we're going to see a crazy 40% correction like we saw back then, simply because I don't think the underlying economy is as unhealthy as it was back then, right? But perhaps the charts say something different. I don't know.
Yeah, I mean, I hope so, right? I hope it's not going to get that bad. I would call it healthy like you do, because when an uptrend gets steep like it did before this year, it does need to press the reset button eventually. And whether that's because of valuations or something different, it almost doesn't matter, right? You can rarely ever get these uninterrupted long-term uptrends, especially at this sort of level of maturity in terms of the bull market. So I think of it that way. Most corrections are healthy, and that should be your initial assumption. I don't have any indications that 12,000 is likely at this time, but I reserve the right to change that. So,
Totally.
We're very fluid in the way that we look at the markets, and we're just trying to help sort of, get a directional bias over different time frames. And as mentioned, it does look more sideways to lower over the, I'd say about 9 to 12 months out is where these indicators are pointing in terms of their duration, because we can go back and take things like that MACD sell signal or the overbought sell signal and test how long those sell signals tend to impact the market. So over time, that's kind of the time frame that we're targeting, 9 to 12 months or so. And it's sure to be a difficult tape. That does not necessarily mean that the economy won't be there to bolster things. One would hope, for sure.
Absolutely. And so 9 to 12 months, I like that you gave a very clear timeline with that. So it seems like for the next 9 to 12 months, people are going to be continually investing, and sure, perhaps they're continually just dollar cost averaging into the markets, but there are those people out there who are saying, holy crap, 9 to 12 months of this, I can't handle that. I need to park my money somewhere safe. What should I be looking for? Is this commodities? Am I doing different types of perhaps like a low volatility ETF? Like what dividends? Like what should I be looking for, right? So where do you think that folks could be learning more about as it relates to a specific type of place to park their money?
Right, and it's hard to do that in the equity market, right? Because the correlations do go up so much. I think the first thought becomes more defensive posturing on the sector front. You tend to get relative outperformance from the likes of consumer staples, as you'd imagine, utilities as an example too. However, relative performance doesn't necessarily mean that you're making money if it's a very weak tape. So, we're expecting at different times for it to be a weak tape this year. It just makes it harder. So perhaps it's not just getting that sector exposure right, which might be difficult, but rather looking elsewhere in other asset classes for different levels of correlations that ideally are much lower than the equity market has. So we can look at treasuries, we can look at gold, we can look at other commodities, and it appears that most recently, energy commodities, so crude oil prices and natural gas have really been a source of outperformance among sort of assets globally. And that's, of course, impacted the energy stocks in a very positive way in what has been a very weak tape. So we are big believers in staying with what is working in the market until it tells us otherwise. And certainly the energy stocks are still working here. So we are recommending exposure there. We're not recommending adding new sort of overweight positions right now, but we are saying for folks that have the exposure to let it grow and take advantage of the momentum and the relative strength in that space is just one source of relative performance that seems to be working both in absolute and relative terms. We don't have major sell signals there yet, and it is a little bit of a different beast than, say, the S&P 500 or technology. Your point earlier on the FANG stocks or the mega caps of the market, like the Googles and the Facebooks and Amazons. Unfortunately, those have all suffered a loss of long-term momentum. And it's for the first time really since the COVID low in early 2020. So as much as they're posting good numbers, unfortunately, it feels like they're, at this point where they're going to tire out a little bit in terms of their price performance. It's not an unhealthy thing necessarily, but I think people need to acknowledge and realize that they're not necessarily going to be good safe havens in this kind of tape.
Absolutely. No, I mean, I wouldn't call PayPal a mega cap, but seeing PayPal trade down 25%, I'm like, whoa, right? It's
and that was such an underperformer, but it's one of those things where it cautions us against trying to buy what looks very oversold. And you could almost put biotech in that category too, or some of the software names, the stuff of the ARK-K ETF. There's a lot of names that look incredibly oversold and perhaps you would know better than I would at good valuations. But let's wait until they really stabilize, because you often need that stabilization, meaning just kind of sideways price action, support discovery, we call that too. And then once you get the upturns in either the intermediate term and or long-term gauges, that's where we'd feel more comfortable trying to position for at least a relief rally that's somewhat tradable in its duration.
Got it. So sort of recap here, safe haven seems like gold and treasuries as well as energy if you already have exposure to it, right? It's not like, hey guys, let's jump out, let's jump ship. It's more like if you're already in it, let's ride the wave until we see it turn sour. But if you're not in it, don't load the boat, because there's really no reason to get rid of cash. That's what I guess, is that what I'm hearing here?
Yeah, I think that's a fair interpretation. And I mean, there's other ways, of course, to get the exposure to energy commodities in particular, but the stocks are working. So, to the extent that that's probably grown as a percentage of folks' portfolios, I think that's okay for now. We are overweight that sector. And yet, it probably won't last forever, right?
Got it. So final question here, and we didn't really even talk about this beforehand, but like, is there anything that you should be, something you tell like just the novice investor trying to navigate this right now to like just caution them on is like, so for me, something that I'm thinking about is I am trying to continually talk toward on Substack, like, yes, things look scary now, but like this is when we should be deploying money, right? This is when we should be just investing into our highest conviction ideas. Like, don't be scared to take that intermediary loss where in 5 years we know that might not be a loss at all. Is there something like that or something at all that you're really just like cautioning towards your audience and like what people are keeping up with on your side of things?
Yeah, I think about market sentiment. Forgive my noise here.
You're good.
I think about how market sentiment needs to kind of flush out, right? Typically before you get a major low. And I would argue that has not happened. So I really wholly believe in market timing because I think, why not try to, buy the troughs, right? Because, or else you're going to find yourself having to climb out of those holes. And then, of course, you're just at a disadvantage in terms of, if you watch your position take a haircut of 20, 30% while you had to, do better than that on the upside to get out of that hole, right? So I really believe in that market timing element. But to your point on the, when things do this, when they do correct overall, it is when sentiment is at its worst that you tend to get the lows. So it's hard to buy when it's often the right time to buy. I would say that we're probably not there yet, just based on my comments. But I think that sentiment, so once it gets a bit worse and you feel like the world is ending, that's probably going to be when we should start to build exposure. And we do have ways to measure market sentiment, but we always like to enhance that with those same indicators that you saw, those momentum gauges, things like the MACD, because you want to see that sentiment get super bearish because that's contrarian positive. But then also you want to see that upturn in momentum, or else you could be buying the falling knife. Gotcha.
Katie, you're a rock star. Thanks again for joining us. Everyone, go check out Fairlead Strategies, both on Substack and on her website, or just tune into CNBC at any time and you will likely see her on your screen. She's amazing.
Thanks, Austin. Take care.
Thanks. All right.